Welcome back to the Deep Dive. It is Tuesday, February 10th, 2026. And if you listen closely, you can hear a very specific sound echoing across the country.
Ah, yes.
It's the sound of millions of Canadians reluctantly dragging shoeboxes full of receipts out from under their beds.
The annual excavation. It's funny how a year feels so long until you have to account for, every dollar you spent in it.
Truly, it is officially tax season. And look, I'll be honest. Usually my strategy is sort of ignore it until April 29th and then panic.
A classic.
But the mission for today is to actually get ahead of the curve. We're calling this Mastering Your 2026 Family Taxes. We've got a stack of research here on new brackets, some disappearing credits, and a few housing benefits that look pretty lucrative.
It's a good year to pay attention. The landscape has really shifted. If you're just on autopilot, based on what you did last year, you were likely leaving money on the table.
Or worse.
Or worse, you're expecting a refund that isn't coming.
That sounds ominous. But before we get into the gotchas, I want to give credit where it's due. Today's deep dive is powered by Minoris Financial Services.
Right.
We're going to be throwing a lot of numbers around. Brackets, thresholds, carry-forward rules, and honestly, if your eyes glaze over, that is your sign to call a pro.
Specifically, Mansour at Minoris. We're going to cover the what and the why today, but Mansour is the guy for the how.
Exactly. If you want to skip the headache, you can reach him at 778-898-3202, or just email mansour@munires.com. We'll remind you later. But let's get into the meat of this.
Let's do it.
So I keep seeing headlines about a middle-class tax cut, and I'm always skeptical when I hear tax cut. It usually means tax cut for someone else, but this looks real.
It is real, but the timing is tricky. This is where people get confused. The federal government reduced the lowest tax bracket rate from 15% down to 14%.
Okay, a 1% drop. Is that actually significant?
Well, on the surface, 1% sounds like a rounding error, but you have to apply that to the first massive chunk of your income. For the 2026 tax year, the one we are living in right now, that 14% rate applies to the first $58,523 of taxable income.
So that is money staying in your pocket.
On every single paycheck.
Okay, so that's for this year. But we're filing for 2025 right now. So did I get the cut last year?
Sort of, and this is the gotcha. The cut became effective July 1st, 2025. So for the return you are filing this spring, you're dealing with a blended rate of about 14.5%. You won't feel the full force of the cut until next year's filing.
Right, so don't spend the refund before you get it.
Precisely. But there is another number that affects your refund right now, the basic personal amount, or BPA.
This is the tax-free zone, right?
That's the best way to think of it. For 2026, due to inflation indexing, the government raised this to $16,452. That means the first $16,500 you earn is yours. The federal government doesn't touch it.
Provided you aren't, a millionaire.
Correct. If your net income is over roughly $181,000, that amount starts to get clawed back. But for the vast majority of families, that's your baseline.
Okay, that's the good news. But I was reading through the source material on credits we've lost, and this one actually hurts. The carbon rebate.
Yeah, this is the sting in the tail. We spent the last few years getting kind of conditioned to that quarterly deposit, the Canada carbon rebate.
People built their budgets around it. I know I did. That was the Costco run money.
Well, you need to adjust that budget. As of March 15th, 2025, the policy shifted. The federal fuel charge stopped for individuals, and consequently, the rebate stopped.
So if I'm sitting here in February 2026 waiting for an April deposit.
It's not coming.
Wow.
It's gone. And for a family of 4, that could be a gap of, $800 to $1,000 or more annually, depending on where you live. This is why you can't just copy-paste last year's tax return. The cash flow is fundamentally different.
That is a serious hit. Okay, let's pivot to where the government is putting money. If you have kids, the sources are pretty enthusiastic about the Canada Child Benefit, the CCD.
They call it the crown jewel of the system for a reason. Because of that inflation indexing we mentioned, that 2.0% bump, the payments for the July 2025 to June 2026 benefit year are substantial.
Run the numbers for me. What is a toddler worth these days?
Well, in terms of the benefit, a child under age 6 can net you up to $8,157 tax-free.
Wait, pause on tax-free.
That is the most important part. It is not income. You do not report it on your T1. It's pure net cash. For a child age 6 to 17, it's up to $6,883.
That's significant. But, and I have to play devil's advocate here, that money goes out as fast as it comes in?
Yeah.
Daycare is insanely expensive.
Oh, absolutely. Which brings us to the child care expense deduction. And I want to be very specific about the word deduction here because people mix this up with credits all the time.
What is the functional difference for the listener?
A credit usually gives you a set percentage back. A deduction lowers your taxable income. So if you are in a high tax bracket, a deduction is incredibly valuable.
Because it's saving you money at your highest marginal rate.
Exactly.
Okay, but there's a rule about who claims the child care, right?
Yeah.
I can't just assign it to the high earner to save more tax.
You cannot. The CRA is onto that game. The rule is childcare expenses must generally be claimed by the spouse with the lower net income.
So the lower earner gets the deduction.
Correct. The logic is that the deduction allows the lower earner to enter the workforce. There are very few exceptions, like if the lower earner is in prison or full-time school, but 99% of the time, the lower earner has to claim it.
And what counts? Obviously, daycare centers.
Daycare centers, yes. But also nannies, day camps, and even boarding schools.
Wait, day camps, like send the kid to play soccer for a week in July camps.
Yes. If the primary purpose is childcare to allow you to work, it counts. So you need to dig those receipts out of the email trash bin.
That is huge. I usually just delete those. Okay, let's talk about the category that scares me the most because of all the math involved. Medical expenses.
It scares everyone. It's the most overlooked category because people think, oh, I have provincial coverage or I have a plan at work. They just assume they don't have enough expenses to qualify.
Is there a threshold?
There is. You can only claim expenses that exceed either roughly $2,700 or 3% of your net income, whichever is less.
Okay, so if I make $50,000, 3% is $1,500. I have to spend more than $1,500 out of pocket to get anything back.
Exactly. Which sounds like a lot until you look at what's eligible. It's not just prescription drugs, it's private health insurance premiums.
The premiums you pay for your work plan.
That counts.
What about the weird stuff? The sources mentioned gluten-free food.
This is a classic pain in the neck but worth it deduction. If you or a dependent has celiac disease, you can claim the incremental cost of gluten-free products.
Define incremental.
This is the tedious part. You can't just deduct the $8 price of the gluten-free bread. You have to subtract the cost of a normal, let's say, $3. So your deduction is $5.
You have to track the difference on every single loaf of bread.
You do. But think about a family with a celiac teenager. Bread, pasta, cookies, crackers over 12 months. That incremental cost adds up to hundreds, maybe thousands of dollars. That easily pushes you over the 3% threshold.
That is a lot of spreadsheet work.
It is. Another big one is travel. If you travel more than 40 kilometers one way for medical services you can't get at home, you can claim those travel expenses.
And if it's even further?
If it's over 80 kilometers, you can claim meals and accommodation. So if you live in a rural area and have to drive to the city for a specialist,
Keep your gas receipts.
or use a simplified per kilometer method, it all adds up.
And what's the strategy for filing this? Do we split it?
No, never split it. That's the amateur mistake. You want to combine all the family's medical expenses, yours, spouse, kids, and put them on one return.
And by combining them.
You smash through that 3% threshold once rather than trying to hit it twice separately.
Smash the threshold. I like that. Before we leave the family section, I have to ask about the disability tax credit, the DTC. The notes here say it's often missed.
It is. People assume disability means a wheelchair. But the CRA definition is about a severe and prolonged impairment in daily living, hearing, vision, walking, but also mental functions.
And the money involved is serious.
Very. For an adult, the federal credit alone is worth over $1,500 in cash back, but the credit amount itself is over $10,000. Plus, it opens the door to the RDSP, the Registered Disability Savings Plan, which is a whole other thing. If you have a child with a severe learning disability or type 1 diabetes, you need to look into this.
Okay, let's move to the biggest line item in the budget. Housing. There's a new acronym in town, the FHSA.
The first home savings account. I call this the Holy Grail account for young Canadians.
Why Holy Grail?
Because it breaks the rules of tax gravity. Usually, you either get a tax break when you put money in, like an RRSP, or you get tax-free withdrawals, like a TFSA. You never get both. The FHSA gives you both.
So I deduct the contribution from my income today.
Yes, lowering your tax bill now.
And when I take it out to buy a house.
It comes out completely tax-free. No tax on the growth, no tax on the withdrawal.
But here is the question every skeptic asks. What if I don't buy a house? What if I decide to rent forever? Is that money trapped?
No. And this is the strategic brilliance of it. If you don't buy a home after 15 years, you can roll that money into your RRSP tax-free.
Does that burn up my RRSP contribution room?
It does not. That is the loophole. It essentially creates extra RRSP room out of thin air. So if you are renting, even if you aren't sure you'll buy, you should be maxing this out just for the extra tax-sheltered room.
That is wild. What's the limit?
$8,000 a year, lifetime limit of $40,000. If you have adult kids living in your basement, tell them to open this account immediately.
Speaking of basements, the multi-generational home renovation tax credit. That is a mouthful.
It is, but it's valuable. We have a lot of families in the sandwich generation caring for kids and for aging parents. This credit is designed to help you build a space for grandma or grandpa to move in.
What qualifies? Can I just put a pull-out couch in the den?
No. The CRA is strict here. You have to be building a secondary suite. That means a self-contained unit. It needs a private entrance, a kitchen, a bathroom, and a sleeping area.
So a real renovation.
A real construction project. But if you do it, you can claim 15% of your costs up to $50,000. That is a $7,500 refundable tax credit. That's check back from the government.
That's significant. Okay, we're in the home stretch here. Let's talk about future you. Wealth planning. It's 2026. RRSP versus TFSA. Give me the cheat sheet.
The classic debate. The logic hasn't changed, but the numbers have. The RRSP is for the high earner. If you're making $100K plus, you want that deduction now to knock you down a tax bracket.
Deadline.
March 2, 2026. If you miss it, the contribution just counts for next year.
And the TFSA.
The TFSA limit for 2026 is $7,000. This is for flexibility. If you might need the money for a car or a wedding, use the TFSA. You don't get penalized for taking it out.
Okay, here's a specific scenario. Tuition credits. A listener's kid is in university, racking up tuition fees, but the kid has zero income.
This is a great family strategy. The student has these massive credits but pays no tax, so the credits are useless to them right now. They can transfer up to $5,000 of those credits to a parent or grandparent.
So I get the tax break because I'm paying the tuition.
Even if the student pays the tuition, as long as they agree to sign the form, the parent can use the credit. It's a way to keep family cash flow healthy.
Okay, my head is spinning a little bit. We've got gluten-free bread calculations determining if a basement has a self-contained kitchen, tracking FHSA carryover limits.
That's a lot.
And the CRA is telling everyone, just autofile. Click the button.
Look, autofile is great if you are 19 years old, have one T4 from a coffee shop, and live with your parents. It's fast. But for the people listening to this, for families, autofile's a trap. Because the CRA's computer only knows what has been reported to it. It knows your T4 salary. It does not know you drove 80 kilometers to a specialist. It does not know you renovated the basement for your mom. It doesn't know you should transfer the tuition credit.
It's a blunt instrument.
It is. It will calculate the tax correctly based on the info it has, but it won't optimize your situation. It won't act as a strategist.
And this brings us back to Moonris.
Yeah.
Because frankly, I don't want to calculate the incremental cost of bread.
And you shouldn't have to. This is why we partnered with Mansour at Moonris Financial Services for this deep dive. A tax professional isn't just a data entry clerk. You are paying for the strategy. You are paying for someone to look at your messy shoebox and say, hey, you missed the disability tax credit, or let's restructure who claims the childcare.
It's the difference between filing and planning.
Exactly. Mansour looks at the complete family picture: income, housing, future goals. He ensures no credit is left on the table.
So if you are feeling overwhelmed or just suspect you're missing something, reach out. The number is 778-898-3202. That's 778-898-3202. Or email mansour@muneris.com. You can also find them at muneris.com.
It's the best investment you can make this season.
So let's wrap this up. We've covered the cut, the kids, the house, and the future. What is the one thing you want the listener to take away?
The aha moment for me is realizing that the tax code isn't just a collection of penalties, it's a collection of incentives. The government is literally paying you to save for a home with the FHSA or support your kids with the CCB. If you view tax season as just paying the bill, you lose. If you view it as claiming your benefits, you win.
Passive versus active. I like that.
But I want to leave you with one final, slightly provocative thought. We talked about what you claim, but in 2026, we need to talk about where you are.
You mean residency?
Yes. We live in a world of digital nomads and snowbirds. People think residency is just counting days. Oh, I was in Florida for 180 days. I'm safe.
Is that not the rule?
It's not just about days. It's about significant ties. If you move to Dubai to work remotely, but you leave your spouse, your dog, and your bank account in Vancouver, the CRA considers you a resident. You owe Canadian tax on your worldwide income.
Ouch.
Conversely, if you spend too much time south of the border, the U.S. IRS might decide you are a U.S. resident for tax purposes. You do not want to be accidentally liable for tax in two countries.
So where you sleep isn't the same as where you pay.
Exactly. If you have international ties, that is a minefield. Do not navigate it alone.
A sobering thought to end on. Thank you for decoding the madness.
My pleasure.
And thank you to Moneris Financial Services for making this episode possible. Good luck with the receipts. Don't wait until April 29th, and we will see you on the next deep dive.